Hello there, welcome to Berman's Call. I'm here with Larry Berman, and Larry's here to take your questions on large cap stocks and ETFs. There's the number, 1-855-326-6266, or email bermanscall@bnnbloomberg.ca. Larry, great to see you. You are going to be talking a lot later about how to play this Trump chaos or volatility, let's call it, but just give us one or two pointers.
Well, I mean, I think for the week here, Andy, NVIDIA's earnings are going to pull a lot of investor attention. But last week we heard from Microsoft, and there was a significant shift in their thinking about AI and investment in AI. And that those two combined, to me, are a big part of what's Friday's reversal was about, and what we're likely going to see after NVIDIA's earnings on Wednesday this week. Does NVIDIA confirm some of that caution that Microsoft put out? Part of it's coming from DeepSeek and what came out of China in terms of some competition for AI. So really that matters a lot. And then you've got the whole volatility around Trump tariffs and policy. And again, we'll try to unpack that a little bit in the educational part of today's show and what's now becoming known as the Mar-a-Lago Accord.
Yes.
So we'll see what that all means for investors at the end of the show.
It's interesting. I mean, we got that report from TD Cowen today. I'm sure you saw that they felt that, or they saw indications that Microsoft was pulling back on leases for data centers. Microsoft says, no, our spending plans are unchanged. But that gave tech investors a bit of a fright this morning.
It did indeed. The uncertainty, when you have a marketplace that's priced for perfection, anything that questions the status quo or news that's better than expected is going to create a lot of volatility. And we're just in that environment right now. So I think investors need to get used to what we'll call tape bombs. In other words, some stuff that comes out.
Tape bombs. It's interesting to note that the Mag 7, as of today anyway, were down this year, dragged down in particular by Tesla, but NVIDIA was pretty flat so far in 2025.
It is. And so Apple's done a little bit better, and it was a little bit of a laggard last year, and Google's done a little bit better, and it was a little bit of a strong shower last year. So there's been some rotation even within the Mag names, but overall, when you look at their contribution to earnings growth and the surprise on the upside, it's not coming from that sector directly anymore. And that was relatively new for the fourth quarter. So again, what was leading is not necessarily leading going forward.
It's a bit of an old story now, but it looks like we might only get one interest rate cut from the Fed in 2025, or maybe none. Does that change your view on the interest-sensitive sector, Larry?
Well, I think a lot of that is priced into the market already. That narrative has been communicated by the FOMC and its members for a number of months now. We saw the big shock turn, pivot, if you will, from Powell in December. So it's not new information at this point, but the market was aggressively pricing and easing. They managed to get that priced out. And what's likely to happen now is it's going to go the other way, right? It goes extreme one way and then it goes extreme the other way. And whether that's, excitement over AI or it's, expectations around interest rate policy. The markets tend to move from extreme to extreme.
Larry, I just want to, this will bring back memories for Canadian investors. Apparently in Taiwan, they have a cap that any single stock can have in ETFs that track indexes. And now Taiwan Semi has gone to about 37% of the local index. So reminiscent of Nortel all those years ago.
Oh, I remember that well. And there was a period where no active manager in Canada could beat the TSX for 2 or 3 years because you couldn't justify owning that much Nortel. as a manager who picks stocks. And so the concentration in Canada has always been an issue. So we're kind of used to that in Canada. But in Taiwan, that's dramatically grown. Same thing in Denmark with Novo Nordisk becoming such a big part of their marketplace as well. So there's pockets of it in many places in the world where you have huge success.
It's great to have you here, Larry. Larry Berman will get to your phone calls and emails on large cap stocks and ETFs next. There's that number, 1-855-326-6266. Let's kick off with an email from Don in Vancouver. Hi, Larry. I sold some US tech stocks that ran up to lofty levels. Have no immediate plans to deploy the cash in stocks. What would be a good vehicle to park this US cash for a year or two? Thanks.
So a couple ETFs come to mind, and it depends how much interest rate you want to take, risk you want to take. But there's a couple of ETFs that are money market oriented. BIL and BILS in the US, and one is 0 to 3 month interest rates and one is 0 to 1 year interest rates. So, your expectation on parking cash, you can go a little bit longer than that and get up to 2 or 3 years interest rate exposure with an ETF with the ticker SHV and SHY. So there's a number of different ways to play interest rates. A lot's going to have to do whether you think interest rates are going to fall or not, and whether you want to take that little bit of extra interest rate risk and try to benefit from cutting rates in the future. Now, I do think the Fed is going to end up cutting rates, but I don't think they're going to cut rates for about a year and a bit at this point. So, mid-2026 perhaps is kind of when the Fed would, economy would be falling and the Fed would have to start cutting rates. So that's my expectation at the moment, subject to change. Tune in every Monday at 3 p.m. for an update. But right now, either one of those two bills, ETFs, will get you a nice yield in the upper 4% range, and that's pretty good at this time. And I think that yield will stick for a while.
Could you give it? Sorry, Larry, give us those tickers again very quickly, if you would, please.
BIL.
BIL.
And that's the 1 to 3 month, and BILS is 3 months to 12 months. So it gives you a bit longer term interest rate, but they're both money market T-bill funds.
Mitchell is in Oshawa, Ontario. Go ahead, Mitchell, please.
Yes, I was just wondering what Larry thought about. I own some ZPay, which is large financials. The yield is about 5.89%. I was just wondering, do you think it's actually going to stay around that, or take off downside, or what do you figure about that?
Thanks.
Yeah, so this is one of my favorite ETFs. Use it a lot. It's writes puts on stocks to buy lower, and it sells calls once they own them to sell them, and it generates a yield of about 6%. And so I really like it. Now, if the market goes down heavy from here, it'll fall about half of the rate of the market. If the market goes up big time, it'll go up about half the rate of the market, but you're getting a very tax efficient income coming off of US stocks. And that's one of the hardest things to really get into a portfolio is tax efficient income coming off US stocks. Because when a US stock pays a dividend, it's treated as regular income. So this is a more tax efficient strategy, but it's not immune from market volatility. Now you're looking only here at a price chart. Remember, you've got to add 6% a year to that in terms of your total return. So a lot of the charts that are shown on BNN do not include the income distribution. So securities that pay high income don't get reflected properly in a chart like that.
I know. It would be great if our system would show total return at times. I'm just working off Bloomberg data, not off the fund's website, I got to admit. Bloomberg is showing 44% cash in this one, Larry. Does it go to a heavy cash weighting, or is that some...
Well, that's why, because that cash is margin against shorting the puts to get the extra income.
I see.
So they short the put, they get the income. That income is treated as a capital gain. if the price goes down to that put level, they must buy the stock, and that's what the cash is there for. It covers that investment so that they'll purchase the stock if it goes to those price. Otherwise, they just earn the income.
Let's head to Rob in Calgary. Go ahead, Rob, please.
Hi, thanks for taking my call. I'd like to hear Larry's opinion on HMAX. That's Hamilton's Canadian Financial ETF. I understand that they write covered calls on what I think is about half of their holdings, but the advertised returns are around 14% annually. How do they achieve that kind of yield, and would you recommend this in ETF for an investor looking for income? And if not, can you offer a better alternative? Thanks for taking my call.
Thanks.
Yeah, so there's a couple companies like Hamilton that they do a very, very good job at what they're doing. And so this is a basket of financials. I believe there's some leverage, but there might not
no,
be.
They're saying...
I'd have to...
No, Larry, yeah, I was
that.
just checking that. They say right now on the website we don't use leverage, but yeah, I was just checking that. Thanks. Carry on.
Yeah, so often that's the case, but if they're saying there's no leverage there, then there's no leverage. In order to generate that kind of yield, they're writing the options like right at the money, meaning you get no upside potential in the stocks or very, very little, and they're focusing on getting that income. Again, when you write a covered call, your income is very tax efficient. So if you look at a total return chart on something like that over a longer period of time, what you end up seeing is you get a very, very high. So I'm looking here since it came out. I've got only history back to almost 2 years now. Looks like about 2 years. Yep. Well, in that 2-year period, the price is actually down 10%. The total return is 20, and so the net return is 9. So just do that math annualized. So, you just got to work with that in your head and understand that you're going to have the net asset value of the fund not growing very much. It's going to be replaced by tax efficient income, but you're not really getting any upside. If you want to participate in the financials and you want growth, BMO ZWB, for example, in an up market, is probably going to do a little bit better than that. So, have a look at that one, but they're going to be similar in that sense.
Yeah, I'm just looking here, Larry, going back to, as you say, 2 years to January of 2023, I'm showing a total return from HMAX of about 20%. And from the banks index on the TSX of about 26%. And ZWB is pretty similar.
Yeah. So a lot of these are designed not to trick investors. That's not what I'm saying. They're designed to generate higher levels of income, but your give up is growth.
Yeah.
So if you're really bullish and you think there's a lot of growth coming, you don't want any of these ETFs that have the derivatives in them. You just want to own the plain underlying securities. If you need tax efficient income, then you've got to consider some of these. And that's really the message to investors.
We have an email from Andy in Calgary. Could I get your thoughts on Templeton Emerging Markets Income Fund? TEI is apparently a ticker symbol there for that one. Yeah, it trades in the States, TEI.
Yeah, so that's an emerging market bond fund. I believe it's actively managed. And so again, here's the question. Why would you want emerging market debt at the moment in your bond fund as part of your fixed income exposure? So you get a higher yield. You get potential big currency risk in emerging market debt. So that's a factor to consider as well. When you look at its performance over the last 5 years relative to a lower cost benchmark ETF as emerging market bonds like EMB, they're very, very similar. But net over a 5-year period, that asset class has made you absolutely no money at all. So I would say for most investors, it's an avoid. Emerging market debt is a relatively sophisticated investment. And so, on a broad basis, without knowing more about the person who wrote in this email, whether it's appropriate or not. But I would say it's in a void as an asset class for most investors. There are going to be periods of time where it's very, very attractive and you can make a lot of money on it. But that's going to be in a period where you think the US dollar is going to weaken significantly and that these emerging market currencies are going to appreciate. I don't think we're there yet. It might come in the next year or two, but it's probably not ideal for most investors at the moment.
Pat is calling from Bradford, Ontario. Go ahead, please.
Hi. I'd like to know Larry's thoughts on the Canadian pipelines, Enbridge and TransCanada. And do you ever think there will be political will to expand to the East Coast? Thank you.
Thanks.
Boy, if I knew the answer to that, I might be Finance Minister of Canada before you know it. Anyways, the challenge with pipelines, like you had this massive run up recently, and I think we've now seen the best of that, and I don't love them here. Where's technical support for these? Like it really starts to kick in around $50, maybe 55 in terms of so there's more downside in the short run than there is more upside. I like the exposure. But I'd be very, very cautious in the short run. If we get a change in government in Canada, whenever that election is going to be this year, that might be the narrative where we start to think about a change. But right now, those charts just broke some important technical levels, and I think there's some more downside. I'm out of them in my exposure and my funds.
Let's squeeze in one more caller. Bev in Scarborough, Ontario. Go ahead, Bev, please.
Oh, I'm at Worsley, Alberta.
Oh, well, that's fine, too. Go ahead. Sorry about that.
Yes, I'd like to know if now is a good time to be more aggressive. Like I've got lots of investments, like in select growth, but I wonder if I should, with the way the markets are, if I should get them into more like select aggressive growth. And also the idea of gold is awfully high right now and stuff. And is it actually a good time to invest in it?
Sure.
I usually buy when it's lower. But
sorry, Bev, we better keep moving here because we're tight for time. Sorry to cut you off.
I mean, I think gold stocks are cheap relative to the price of gold. And I think gold is an asset class where we have significant uncertainty about central bank debt for a number of years into the future. Is going to be, a definitely buy on dips. This recent run up here, I'd be a seller here, not a buyer. But if we pull back to, call trend at this point, 2,700. If you drew a line, if I was sitting in the studio, I would draw you a line up under the lows there and project that out in the next couple of months. So I'd be buying on dips, 10% lower. But at this point, I'd be lightening up a little bit in terms of gold. Is this a time to get more aggressive? No, the markets in the U.S. have never been more expensive, fundamentally. There's all kinds of reasons for it, but there's a lot of risks too. So I would be very cautious on expanding my risk in markets at this point.
Coming up, Larry's educational segment, he is going to take a look at Trump's policies.
Berman is one of Canada's top technical analysts. He's the Chief Investment Officer of ETF Capital Management. To learn more, visit etfcm.com. Opinions expressed by Larry Berman are his own and do not necessarily reflect the opinions of BNN, its parent company, or affiliates.
Welcome back to Berman's Call. I just want to give you some breaking news. U.S. President Donald Trump quoted as saying, when it comes to these tariffs on Canada and Mexico, we are on time. And it seems like that's moving very rapidly. So he says it's going to go forward on time, those tariffs on our two nations. Larry, that feeds into your educational segment. Please take it away.
Well, it does. There's a lot on the Twitter sphere or the X platform or whatever we call it these days. And I reposted some stuff from a couple of thread pieces. So one from Jim Bianco and the other from Andy Constant on the pros and cons of what this whole thing is now known as the Mar-a-Lago Accord that investors are talking about. So the essence of it is that the federal budget in the U.S. is on an unsustainable path. Everybody knows this. It's not a secret, except the political system in the U.S. has been completely inept in terms of trying to deal with it. So enter the Doge committee, Elon Musk firing federal employees by the hour, it seems. Let's bring up this first chart, and it really drills home the message. So this is total federal debt as a percentage of GDP. This was in Jim Bianco's post on the weekend. And based on the Congressional Budget Office forecast, it's going to get worse and worse and worse in the years to come. And the reality is what is coming out of Mar-a-Lago and Trump's policies are trying to fix this. Because generally, Congress, under every government in recent years, has been completely unable to deal with the growing debt. And so raising revenue. So this is where the tariffs come in. Bringing more jobs to America. That's going to be more tax dollars for the U.S. So any policy like that is actually going to be a positive in terms of helping, except they're very, very inflationary. And so that's the big message here from the market standpoint. Number two, create a sovereign wealth fund. And so taking Social Security, investing it better, taking some of the U.S. assets and investing them better than they are today, revaluing gold. That idea has been floated out there, and I think that generally speaking would be a very, very good idea. And then finally, reducing debt overall. Well, that really is Congress. And Doge is going to, get rid of definitely some baggage in terms of government. Another idea that was floated was issuing a zero coupon 100-year bond. Impossible. You can't force anybody into buying that debt unless you say, you must buy that debt or we're not going to protect you anymore from a sovereign NATO relationship. And, he's using some of that. So while I don't love Donald Trump's style, he's starting to get things done, and it's going to be disruptive. And to me, that means more market volatility. The last chart here that I want to show is the real big problem. And that is why we need to keep inflation under control, is the cost of the interest on the debt is just going to get worse and worse and worse and worse. Any inflationary policies are a problem. And so I'm not sure that they have a full and complete solution here. And it's going to add volatility. At some point, the markets will care. Right now, they don't seem to care, Andy.
Thank you very much, Larry. We'll have to leave it there. You can follow Larry online. He's platform agnostic. He's got lots of channels. ETFcm.com and qwealth.com are two of his sites. And he's on YouTube naturally and on X. And there you have it on LinkedIn, Larry Berman. Thanks very much indeed for watching. The close is up next.